Larry Shover joins us from Efficient Capital Management. Larry, considering that reaction from equities as the comments from Bono came through, do you think maybe the market can't take this debt deal for granted, maybe, as in the past really markets have?
Yeah, well, keep in mind that I think today's rally was really like a Bernanke sham. I mean, you were right. We're up over 100 points today, and we fell off and only ended up 0.5%. I mean, a lot of it was due to the fact that Bernanke articulated some options that he had at his disposal, something he didn't do in June 22nd. With all that said, people realize, like, this debt ceiling thing is a real issue, and we're not getting it figured out. I completely agree with John that they will figure something out. But right now, the market doesn't like it. There really is no action right now. We're rallying and breaking on nothing. Until this gets figured out, this is what we're going to see, more of the same, up and down 0.5% a day.
So maybe you can add to John's comments as well on Bernanke and the conditions that would justify additional easing from the Fed. Larry, have you got us there?
Oh, I'm sorry. I thought you were speaking to John. Yeah, the conditions would be that we'd have zero growth in the second half of 2011, and I don't think anybody sees that happening. I mean, I think on an adjusted basis, 3% second half growth seems reasonable. If we have zero growth, I think Bernanke will step in and do something pretty drastic, because really what's left in his toolbox is fairly drastic, and I don't think he wants to pull anything out until he has to.
Larry, John Linden from Thomson Reuters, good morning. We had a very good lead, or Wall Street had a very good lead-in from Asia. Asia stock markets went up quite a bit after the Chinese growth data came in stronger than expected. Is the world very much reliant on China now with the debt problems in Europe and the U.S. economy sort of sputtering along? We're really counting on China now, aren't we?
We are, and the United States is becoming more like Australia in that way, where we really are worried about is the private economy in China intact? Are they hiding municipality bad loans like the rest of the world does? All these things, we do care deeply about what's going on in China, and the fact that the consensus estimate for their GDP was 9.3, came out at 9.5. I mean, it was a great boon. It was a great way to get us all started, but we are really deeply interested in what's going on, and our markets reacted accordingly.
Larry, we saw debt markets in Europe calm just a little bit today, but is that still a major wall of worry for U.S. investors, the fact that the European debt markets, there's so much uncertainty left in those markets still?
Yeah, there's a lot of uncertainty, but some cold water got put over it today with the news from Italy that their $40 billion austerity package was going to be voted on, is going to be approved. So, they kind of put their finger in the dike with that one and kept that one at bay. And we keep hearing the news that the French and the German banks can absorb a haircut from Greece, et cetera, et cetera. So, yeah, we're worried about it. And, I mean, obviously, American banks have great exposure to German and French banks, so there would be a contagion effect. But the stock market doesn't seem to be too worried about it, so therefore the investors aren't worried right now.
How are all of these factors playing into the copper price, which is supposed to be the barometer for global growth, but there's so many kind of push-pull factors? You've just talked about the growth in China better than expected, but the problems in Europe.
Yeah, so copper prices right now we close at about $4.39 a pound. It seems like a little bit overdone. Keep in mind that the Chinese are not buyers of copper right now, and you can see that just in the inventory. They don't like prices this high, and they're going to wait. But I think copper, by and large, will continue to rally. There's going to be more demand than there is supply, and it's a great indicator of the health of the worldwide economy, given the fact that China is uses 40% of the world's copper production.
And the gold price, we have to throw that in as well, because that hit some record highs today. I saw some people saying gold's back, but I think Larry Shover would say it never went away. We've had cheap money. It was never going to go away.
Yeah, thank you for that. Like 2 weeks ago, it was $100 lower. But, at the end of the day, it's just that if you believe, like me, that Gold is a casual driver of global liquidity, and if you feel like money, now Australians can't really relate to this because your money is not cheap, but everybody else's money is. If you feel like money is going to remain cheap, then gold has to rally. Now, today's rally is maybe a little bit overdone. Should it be at 1580 right now? I'm not sure. They're talking about $1,600 by the end of the year, but you're going to see a lot of demand support from central banks, et cetera, as we back off back to the 1550 range, if we ever see that.
Larry, John Noonan again. The gold is also a currency play because there's certainly no end to this G3 ugly contest that we're seeing between the U.S. dollar, the euro, and the yen doesn't hold that much appeal. Do you see gold breaking above 1,600 as the doubts about currency and sovereign debt continue?
Oh, that's a good question. I do see it eventually above 1,600, especially if there's some type of QE3 or QE2.5 or doing something to keep our currency cheap and to keep money really free. I mean, I'm of the conviction that money is going to stay this way for a long time. Rates are going to stay low, even negative, for the unforeseeable future. So why shouldn't gold continue to rally well above 1,600? I don't see any reason why that wouldn't happen.
Thank you so much, Larry Shover. Great to have you on the show today. Thanks.